assets minus current liabilities. That's the formula for working capital. And current assets is cash, accounts receivable, and inventory. Okay? So in this case, we're going to ignore cash because we don't want to double count it. So what we're focusing on really is accounts receivable and inventory. Okay. So, so you take your ending current assets minus your ending current liabilities, and that's your ending working capital. And I would subtract cash out of that. And do the same for beginning current assets minus beginning current liabilities. For an existing business. When you're looking at balance sheets for a company that's already up and running, just look at the change in working capital. And it's tedious. It's a tedious calculation because you're going to have to look at current assets minus current liabilities, and that's your working capital. And you're going to have to do that at the end of the year, and you're going to have to do that at the beginning of the year. So it's a little bit tedious. Okay. Then the other way to approach determining your working capital is what I did in the example. And again, like you do with your capital spending, you put together a laundry list. Okay? What working capital items are we going to have to fund, and how much are we going to need? Okay? And again, what are we doing? We're budgeting, we're projecting, we're forecasting. Chances are we're not going to nail it, okay? If we hit it right on, then are we good, or are we lucky? Maybe a little bit of both. Okay, it's an uncertain environment. All right. Question 5. Now we're going to get into some of the fun stuff. A company forecasts they will sell 100,000 units per month of a new product. Who provides that forecast? The engineers? They do the forecasting? Talk to the engineers? No. Andy says no, he's right. No, it's the accountants. They're omnipotent. They're all knowing and everywhere. The accountants. You want to know something? Just ask an accountant. He or she will tell you. They do the forecasting for you, the accountants? No. You don't want to trust a CPA to do your forecasting, okay, when it comes to units in particular, or pricing, okay? Who does the forecasting, the sales forecasting? What discipline? Who are our marketing majors in here? We got a few more. Don't we have any more? Yeah, Coleman. You're going to be doing the forecasting. We're going to come to you. That's your job. Okay? That's one of the things you're going to do, is you're going to do your market research and help us estimate the demand for the product and what the product needs to look like and how we're going to advertise that. Man, you got a lot of stuff on your plate, Coleman. You're going to have to do a lot. So 100,000 units, and the price per unit is $25. $25. Now, once again, who's going to give us that price? Boy, the accountants want to give it to us. They want to tell us. They want to tell us the price. No, we don't want the accountants telling us what the price ought to be. Now, the accountants and the engineers need to tell us what the cost is going to be. And that's what they do. And when they give us the cost, we know what we have to do in terms of pricing. Our pricing had better cover our cost at least. But we're not going to rely on the accountants and the engineers to tell us what the price is going to be. Okay? Once again, we've got to go to the marketing people and say, okay, do your research, let us know what the market is telling you about what they're willing to pay for this product or service. Okay? We can have the best product or service on the market. If we don't price it right, if people just pull back and say, I'm not paying that for that, okay? Doesn't matter if it's the best product on the market. So we need to know what consumers are thinking, and also we need to do our best to try to get consumers to come around to our way of thinking. It's like, you know, you need this product. This product's going to make you run faster and jump higher. What are you willing to pay for it? All right, so what's our annual revenue forecast? if we're gonna sell 100,000 units at $25 per unit, I've told you before that the basic formula for revenue is the number of units times the price per unit. Okay? So, $25 per unit, and this is an annual revenue forecast, and they're giving us 100,000 units per month. So 100,000 units times $25 per unit times 12 months, $30 million. $30 million. So we're going to go through line by line, and we're going to project our revenue and our costs, see what this project looks like, and then we're going to do a net present value on it and an internal rate of return on it, and then we're going to change our assumptions. What if we're wrong? We're going to do a scenario analysis and a sensitivity analysis. What if we have to lower our price to $22 a unit? Okay, the cost stays the same, but our price has to drop. What if we've been a little bit too optimistic on our pricing? What if we can sell at $25 a unit, but we can only sell 85,000 units? What's going to happen to our project? We need to know what our upside is, and most people don't worry too much about the upside. They worry a lot about the downside. So we're going to have to do a best case scenario. We'll start with a most likely case. This is what we think is going to happen. And then we'll do a worst case scenario. Okay? What happens if we blow it? Is it going to take the company down? We need to know that. Alright? Alright, so the company believes cost per unit will be 30% of the price. That's one way of expressing cost per unit, 30% of the price. Another way is to give a direct cost. We talk to the accountants, we talk to the engineers, and they think that we can build this product for X amount of dollars. Okay? So you need to be prepared to express the price either way. So what will be their per unit cost? Well, it's $25 times 30%, $7.50. Now if you watch Shark Tank, those guys walk out and they say, "Sharks, here's who I am, this is my history, here's what my product and service is, here's how much money I need, and here's how much of the company I'll give you." And one of the first things one of the sharks asks is, what's your selling price for this product? And it's $25, all right? How much does it cost you to make the product? $7.50. And man, their wheels are turning. Okay, we can make some money. That's a nice markup on the product. Then they start thinking, how many units? How big is the market? How competitive is the market? What's the best way to distribute the product? That's where you get Lori from QVC. She's saying, I can put this on television. And Damon or Mr. Wonderful are saying, I've got contacts at Walmart and Home Depot, and this is a great product for Walmart and Home Depot. You don't need to go with Lori on QVC. This is not a retail product for television. We need to put this in Home Depot and Lowe's and Walmart, and I got contacts there, and I can make it happen for you. And so as the entrepreneur, you got to decide, hey, who am I going to go with? Who do I believe? I think Lori putting it on QVC is the way to go for this product or not. So your revenue is your top line, and then you have your cost of goods sold. And your cost of goods sold is the same number of units, okay, that you're going to sell, 100,000 times 12 months, times, so you can do it $7.50 times 100,000 times 12, cost per unit times number of units times 12 months, because the number of units, the 100,000, that's a monthly figure, it's not an annual figure, okay? Or you could take the 30 million that you did in total revenue and multiply that by 30%. Either way, you're going to get $9 million as your cost of goods sold, okay? So you've got your revenue, and you've got your cost of goods sold, and you've got your gross profit. What comes after gross profit? Well, SG&A and depreciation. Now, I know most of you don't like accounting. Accounting, make your eyelids heavy, but you got to know the basics of accounting. You can't get away from it. Okay? Even you, Coleman, even in marketing, you gotta know the basics of accounting, because you're gonna be dealing with the accountants, okay? All right, so, it says our annual fixed costs are $3 million. What's a fixed cost? It's a cost that you have that will not go away or will not vary with sales. If your sales are good, fixed cost $3 million. If your sales are bad, fixed cost $3 million. What's a big fixed cost? Debt service. Your debt service. That's what Mr. Shepherd was talking about. If your sales are bad, you can't go to the bank and say, listen, had a bad month, I'm not going to pay you this month. Now you could, but they probably wouldn't like it too much. And if you said to them, if you said to the bank, hey, will you let me go for a month? Chances are they're not going to do it. Okay? Now it depends on the nature of the bank. But that's when, and if they let you go for a month, does that mean that they forgive you? Oh no. That means next month you got 2 months worth of fixed costs. Okay, so they don't vary with sales. So rent is another fixed cost. Okay. Insurance, another fixed cost. These things don't vary. You're going to have to pay. All right, so $3 million in fixed costs. All right, and then depreciation. So SG&A, selling general administrative expense, and then your depreciation. All right, so I tell you here that we are going to have to put up $50 million. We're going to have to buy $50 million worth of property, plant, and equipment. That's an assumption I'm giving you. Okay, and we're going to, for simplicity's sake, we're going to use the straight line depreciation method. Over 10 years, no salvage value. Okay, so we got $50 million divided by 10 is our depreciation expense. Okay, so $5 million, and we got $3 million SG&A. So we got $30 million in revenue. And we got cost of goods sold of $9 million. And we've got gross profit of $21 million. And we've got SG&A of $3 million. And we've got depreciation of $5 million. So our income statement is starting to take shape. Okay? So what do we have here? 13 million. So here's our EBIT. And our tax rate is 21%. All right, don't make me do all the math. Somebody tell me what that is. Tap, tap, tap. Got your calculator out. 13 million times 21%. Somebody tell me, I got it right here, but I'm going to make you do it.
2.73.
2 million, isn't it 710,000? Is that right? Yep. All right. Now we have our net income. Okay. So there's a negative number. And we've got 10,270,000.
You did say 13 million, right?
Uh-huh.
Should be 2.73. 21%?
Somebody do it.
It's
13 million times 21%.
27.3.
So there's a mistake in there.
Yeah, it should be. The 1 to 3.
27, 3, that's a 3.
Yes.
All right, what's this number? Did I have that number right? It happens. That's why I make you do it.
10.27.
Yeah. Like that? Yeah. All right, so that number was right. All right, so there's our net income, but when we're doing cash flows, we don't use net income. Okay? So we use our EBIT. So our operating cash flow is our EBIT plus depreciation minus taxes. Okay? So our EBIT is 13 million. And our depreciation is 5 million. So that's 18 million. Minus our taxes of 2,730,000. What's our operating cash flow? What's our operating cash flow? Don't be afraid, young people. You got your calculators in front of you. Yeah, Michael, I'm gonna let y'all go. So, but I'm not gonna let you go until somebody tells you what 18 million minus 2.73 million is. Thank you. 15,290,000. And that's our operating cash flow. And that's what this problem calls for. So that's one of the steps in the process. Now, operating cash flow is not the cash flow here because we've got our net capital spending and we've got our net working capital that we're going to have to put in there, subtract from that to get to our cash flow there. All right. What? Yeah, let's, I know y'all are going to be exhausted, but let's do a post-test review. Sunday night, what do you say, 7 o'clock? No? What, Michael? 5 o'clock? The sun's going to be out. Sunday at 5 o'clock, that's a bad time. Or not. 6 o'clock? Who can't make it 6 o'clock Sunday? Bring things over. All right, 6 o'clock Sunday, we'll do a test review. And we'll do it in 101.
You want this homework submitted?
Yeah. Yeah, this is a big homework. We'll finish this. Bring 101. Sunday, 6 p.m. Post test review. All right. What branch of the military are you in?
Air Force.
Where were you stationed?
About 7 places, but 2 tours of Vietnam. One flying B-52s out of Ulu-Pao Highway, and one flying Ruby 10s, and 2 Provinces Air Force, one today.
We have a colonel, an Air Force colonel. I need to see if he's around. He's retiring this year. He teaches production operations management. Bob Reilly. Have you met him? Yeah, y'all need to meet each other. Yeah, he flew. So, see you, John. Y'all have a good weekend. Have a great weekend.
Great stuff.
Yeah, that's fun.
I need somebody to do that, because I guess.
Yeah, everybody has their function, you know. One thing I try to tell, my wife teaches sales and marketing, and a lot of times the finance and accounting and info tech people, because they're more technical, they tend to kind of have an air of superiority with them. And I remind them that they're overhead. We're all overhead. It's the marketing people, you know, that make the business happen, you know.
You know, I'm really impressed with a lot of the young people I see today and what they do and how they do it. And I find, I keep looking at it and wondering if I had to compete against these guys, could I succeed today?
Yeah.
Because I'm a big picture guy.
Yeah.
Yes. And I was just sitting there while you were doing that, sticking some other numbers in. It's like we have, the accountants have been worried about me for a number of years. This driving range we have is 26 acres. We have maybe, we bought the ground for 4,000 an acre. Part of this whole complex, of course.
Right.
And
Nice percent.
and so we bought it, and we either had to pay to maintain it, mow it, and take care of it, or we had to do something. So we put it in
She has your test.
a driving range. We knew that there were 3 driving ranges on our side of town. We knew one of them was going. We knew his buddy might own the other, sort of he'd take the ground from this guy. And of course, taking the ground from him takes the sales. Still doesn't make it highly profitable. Takes the sales from about 200,000 to 500,000, with only maybe 50 grand more in The ground was purchased for $4,000 an acre. We put probably $1 million in it. We then ran it for 20 years, losing $3.25 million on it. And the council said, why are you losing money in this? Well, we got an offer a few months ago. The city manager there is real sure in his way. And they offered us, what was the number, 46 million?
Yeah.
For the park, which takes that down to about 4 million an acre, or 10 million for this project. So even now, when we sell it, it's gonna come out ahead.
Right.
And now the decision is, and I'm looking at what you're doing there and saying, I hope Andy can do this when he goes home.
Yeah, he'll be able to.
Because we sold he and his sister the driving range while it was down for a real low price. All going through the CPAs.
Right.
It's, I guess technically you would say it's kind of it's a method of, what do you call it, succession planning.
Right, right.
And succession planning. And it's already this year, looked like it's gonna make maybe 200 this year, which is nice.
Yeah.
But it brings it back into positive cash flow. If you can do a land holding with positive cash flow, it's great. And a lot of the stuff we find, it's like, we might want a farm from a Amish family, and they had 17 families in it. And they were arguing, fussing, and doing everything they could do. And people make really dumb mistakes. It was listed for $10,000 an acre. I made them an offer of some ridiculous number, and they told me no. And then they called me back and says, well, we're gonna counter you. So they countered me at $2,750 for a piece of,
Would you shut that?
for a piece of ground, a major route in, you know,
Just shut the front